Hey, what's good, self-direct investors, and welcome back to another episode of ETFs Explained. If you're new to my channel, my name is Jordan, and I am the mind behind MakeMoreCapital, the financial education brand that hopes to make the world a little bit more financially literate as best as I can with these videos. Now, in this video today, we're going to be looking at two global ETFs that are available on the Toronto Stock Exchange for Canadian investors to get exposure to outside of North America. The first one is going to be XAW with BlackRock, and the second one is going to be VXC with Vanguard. Now, if you missed any of my last videos, I just covered XQQ, which is the version of QQQ, the well-known growth ETF in the US. XQQ is the Canadian version, but you can grab the links to those two if you want to try and find an ETF that should promise a lot of growth. The link will be down there below that you can check that out. Also, if you have yet to open your self-directed tax-free savings account with Questrade, the #1 discount broker in Canada, there's a link down there for you to do that, and you get a little bit of money simply by doing so. I've been using Questrade for 2.5 years. I love it. And if you use that link, feel free to reach out to me, and I will happily assist you in navigating the platform, getting used to it, show you how to buy your first few shares, and how to get the system of dollar cost averaging or the drip set up. You just let me know. I'm your guy. But that being said, if at any point you are enjoying this video or you learn something new, please make sure you hit the thumbs up. I really do appreciate it, and it does help my channel a lot. So enough babbling, we'll jump right in. So this ETF, the first one we're going to cover is the iShares Core MSCI All Country World ex-Canada Index ETF. It's quite the handful, but basically, if we just look quickly here, the investment objective is it seeks long-term capital growth by replicating the performance of the MSCI ACWI ex-Canada IMI index. Thing is, there are many indexes out there that have been going for a long time, that have been tracking the performance, so there's always more to learn, which is the fun thing about doing your own investment research in your own time. But basically, MSCI is Morgan Stanley Capital International, and so this is the company that has made the effort to create this index or hosts it, and it's an index to measure equity market performance in global emerging markets. So if we actually look here, the MSCI ACWI ex-Canada IMI index captures large, mid, and small cap representation across 22 of 23 developed markets. The one missing is excluding Canada, and 26 emerging market countries. So it's actually a little bit more diversified than this one might be, for example, just because it's also in the developing markets and the emerging ones. And if you can see here from the chart, it's actually the hardest one to see, but this one in green highlighted here is for the ACWI IMI one. So if you wanted to find out more about this index, you could just Google this title, search it up, and I will put all the links actually in the bio for this video. But you can see with the index tracks, the same idea. Well, actually, we'll just save it for when we go through here. But you can see the price as of yesterday, August 2020, was $28.26. This means that it closed up 6 cents more than the day before, which is a 0.21% increase in the 6 cents difference. And the year to date, this ETF, the global situation has taken place. A lot of economies are struggling, but markets are still chugging along. This one is up 2.46% for the year. So why would you want to own XAW? It is you would want to own it for global portfolio diversification. The second reason, low cost and a simple way to own U.S., international, and emerging market stocks. So that's the interesting about this one, is it does give you exposure in the top U.S. companies. And again, why not just have your money in them, because you're going to see the most growth out of that. But also it is invested in international developing countries and emerging markets as well. So you're getting good exposure in that sense, and it is designed to be a long-term core holding. Now, if we look at the performance since its inception, which it will tell us a bit lower, but I always just check this way. Since its inception in 2015, it has returned 8.18% on average. So you take all the years divided by the number of years since 2015. So this will be going on its 5th year. But as of 1 year, it's been up, well, it's a little bit different than, okay, so this is the net asset value, but this is the total return of the ETF, I guess, $7.60. Over 3 years, it's done 8.48, which has actually been its best percentage point to look at, and then after 5 years, 7.62. But basically, again, anything over 7 or 8 considering ETF fees are very low, that is a tremendous performance. And it does seem that the dividends have been consistently paid out. They range from, seems like 16 cents upwards to 24, 25 cents. So that's always nice to see, and a bonus as well. Now let's go through some key facts. It is again available on the Toronto Stock Exchange. The benchmark index is the MSCI. So this is where you can get that title next time you want to reference it. It has 44,900,000 outstanding units or shares that you can that are available to be traded, and the number of underlying holdings inside. So this ETF invests in this ETF itself invests in quite a few different ETFs. But 8,780 are within it. So it's very diversified. Again, a lot of these, let's say, companies in these emerging markets, developing markets, even in North America, could go out of business. But there are so many companies inside this ETF that you might see a drop, but you're not going to see it go down to zero at any point. You'll still always get the right to those dividends as you own those shares. And then the index provider is MSCI, Morgan Stanley. It is a 100% equity again. So, it is all in companies and stock. However, that is where you will see the most growth. It rebalances quarterly. Number of holdings is 6. So this is what we'll get into a bit below. One thing that I noticed that BlackRock does is a lot of their ETFs are made up of combinations of other ETFs. So we'll go through that in a moment. But that's what it means by number of holdings being 6 and then underlying holdings being this many. But if we look at the dividend information, the investment program, this just means that you're allowed to set up the DRIP, which is the Dividend Reinvestment Plan. With Questrade especially, you can basically just print off a form, sign it, check a little box that says, if possible, when I'm paid out a dividend and I can afford to buy an entire share or multiple shares of said company, that Questrade will automatically reinvest the dividend for you, which is amazing. That is what the DRIP plan is. The distribution frequency is how often dividends are paid out. This one is semi-annual, so you'll get the dividend paid out twice a year. The 12-month trailing yield is 1.86%. It is eligible for registered plans. So again, the tax-free savings account, the RRSP, the RESP. The last distribution per share was 23 cents. And I guess the distribution yield is just sitting a bit lower than the 12-month trailing yield at 1.64%. But again, this 1.64% represents 0.23 cents out of the original share price. Now, portfolio we just did that. Now, fees. This is where you want to, of course, be most aware, because the lower the MER, the more money you're ultimately keeping in your pocket. The management fee is what they pay to the companies, and the management expense ratio is what you end up paying after returns, and then you get what's left over, net expenses or after expenses. That's what that means. So 0.22% is a little bit higher than what you see with a lot of S&P 500 index ETF, but again, that's just because the S&P is the most general. It's the easiest to track, so they can charge the least amount. Obviously, because you're getting exposure into many different markets, this one's going to cost you a little bit more at 0.22%. The risk indicator says that this ETF is a medium, so yeah, not that risky, but of course you do want to just at least know what you're investing in. And so if we go down, get down here to break it up and see what's actually inside the top 10 holdings. So this is what I mean by it's a little bit different. If you look here and see MSCI, again, the big US companies are what they're invested in, but then you can see here Alibaba, Tencent, Taiwan Semiconductors. So they've got some companies from China, from Taiwan, diversifies a bit. But the way BlackRock works, and they like to do things, is, see, like this is actually invested in the core S&P ETF. 51% of it is invested in IVV. So, it's still good to own a US index ETF like an S&P 500 or any other sort of US-based one, but it's good to know that by investing in this one, you're actually investing 50% into that again. So if you already own it, it's just one of those things you want to consider. It's like your investments are overlapping. If both of them grow, that's fantastic, and truth is both of them will. But it's just something to consider that. And then XEF is the MSCI EAFE, which is Europe, Australia, Far East, I believe. That's another index. And then so The percentage of this ETF, that is, or the percentage of XEF is 28.78% weighted, and then IEMG, which is the iShares Core MCI Emerging Markets. So these would actually be like more developing countries that are poised for more growth, actually. Like if you just think of China, India, a lot of these countries have more than 1 billion people, very high population, so they should be getting the growth once they can incorporate, good systems in place, and that's where people or investors see a lot of opportunity. And it's also in the U.S. mid cap and small cap, and even in U.S. total stock. So honestly, when we look through this, it seems like you're mostly just investing in the U.S. With a little bit of what's going on outside, actually. And then if we look at the breakdown, 58% of it is in the U.S., 7% is in Japan, 4.6% is in China, 4% in the UK, France, Switzerland goes down here. So it does break into all of these different areas. You can check to see, so it doesn't go a whole lot deeper. There's still only a limited amount of countries that they're in. If we check the sectors, mostly info technology, healthcare, consumer discretionary, financials, you want to make sure these are in industries that, they're going to be an industry that's going to stick around and that people are always going to need. And if we just look at all the holdings, well, that's the same thing. Aggregate underlying holdings. So underlying holdings is the company that's inside. We're going to see a lot of the same ones, mostly U.S. companies, but obviously it does get into some of these other markets. So that is kind of the gist of it for that ETF. So we can close that up here, but we will leave this open. We're going to jump over to VXC. Oh, what I just wanted to say is that, of course, you can also check the fact sheet. It's going to give you a lot of the same information, but that is a rundown of XAW. So still good, though, to have that US. I still think a lot of this reassuring returns have been because of how heavily US-based it is. But let's jump into Vanguard. Now, Vanguard actually tracks a different index. This one is the FTSE Global All Cap X Canada China A Inclusion Index. So this one, didn't have a chart that I could find, but this one shows that this past year, it has done quite well at 12.43%. But again, this is this is a fact sheet here. Yeah, let's just pop into here then, and see what kind of performance this has done. But the objective, they're designed for the creation of index tracking. Well, we know that. Tracks FTSE China A. So we are China inclusion. Sorry, folks. Let's just check this again. A inclusion. So the 5-year return has been quite good, actually, on this ETF. I hope that is the same one. But no, I think we're looking at this one. So... Oh, sorry, my mistake. They're looking at different ratios, price volatilities. Basically, well, we'll get a lot of this information. Let's just focus on the ETF. But this is the index that it tracks. My apologies for that detour. The MER for this one is slightly higher than XAW. So this one is 0.26%. So you're giving up 0.04% more than you would be with XAW. And honestly, for an ETF, that is a lot to give up. 0.04 does not sound like a lot, but over 20, 30 years, depending on how long you're going to hold it so that you can have the dividends pay you enough to live off of, the MER is a big thing to consider. So that is one thing that we can see here, that you are actually paying less to own XAW, probably because so much of it is in the US again as well. But we'll see what this objective is. It's to track the Global All Cap X Canada Index ETF, the FTSE Global All Cap China A Exclusion one. And basically, again, these ETFs they're all quite simple, and hopefully after watching a few of my videos, you'll just pick up on how you can do this all yourself. But I would consider this one as probably a medium risk one as well. If we look at the dividend distribution yield, 1.89%, so it pays a little bit. Well, again, the price is, we'll get to that price in a moment. I should jump over. The price of this one is $41.05. Currently, so that's another thing too to consider. So if you wanted to buy, so currently today it closed at $28.22. If you wanted to buy 1,000 shares, okay, I apologize. We'll jump back to that in a moment. But so this dividend here is paid quarterly as opposed to XAW, which is paid semi-annually. So this is one thing to consider, is you're actually going to be getting dividends 4 times out of the year as opposed to getting it only twice. And this one is going to pay you twice with a higher payout. However, you're going to be getting a lower payout, but double the dividend payout. So that is why the distribution yield for this one would actually be higher than XAW. So that is the second point you want to look out for. Remember, the 3 main things are low MER, consistent average returns over time, and a consistent history of dividends. Those are the 3 main things you want to look for in an ETF. So as of right now, we can see that the Vanguard one charges a bit more, but you are getting more dividends out of it, and it is eligible for registered programs, which is obviously nice to see because you can use your tax-free savings account and grow these after-tax dollars. Now, since inception, this one has returned 10.5%, which is pretty good from the last 5 years, 3 years, 1 year, and even this current month. Despite everything that's going on in the global situation, it has been doing fairly well. And so the market price of this one is actually, yes, $41.05. This is, again, as of yesterday. But the performance since inception has done quite well. So, again, although you are getting a lower MER and you are getting slightly less in dividend yield with this one, you are actually getting more growth and better returns. So you just want to try and consider weighing that option. And I can consider making a video on how you would do that over the long term. Although math has never even really been my strong suit, but I'll try and figure that out for you all. But so a hypothetical, if you invested $10,000, it would have done quite well since inception in 2015, at least halfway to doubling your money. Now, if we look inside, the number of holdings inside of this one is 10,000. So if we thought 8,000 was a lot here, this one actually owns 10,000. The market cap is at 74.3 billion. PE ratio is at 20, so it is a little bit on the high side, the price point. But again, the idea of the stock market is just growth over time trajectory. So as long as it's consistently sitting there, unless there's some sort of a crash where we might see the price fall, maybe 20%, and therefore you'll see the PE ratio fall down to like 15, 13, depending where. That is a sign where you want to buy those shares on sale. That is where, understanding the market gives you that courage to actually buy when other people are scared and selling, right? But that's something you get into with practice. Price to book ratio means it's trading at 2 times all of the book, or 2 times book value, which is a lot better than some of the actual growth ETFs we've seen. And the top 10 holdings are Apple, Microsoft, Amazon, Alphabet, Facebook, and this one again, Alibaba, Tencent, Taiwan. So it's the funny thing is they're both pretty much invested in a lot of the same things. And the sector weights: technology 20%, financial 17%, industrials 12 or 13%, consumer directory 13%, healthcare 13%, and the countries that it's allocated in: US, Japan, China, UK, Switzerland, extremely similar to the other one. So, when you break down to what they're tracking, a lot of it is the same stuff. So over time, you get better at identifying these things. We have covered that performance. The portfolio data, I did just want to cover that 69% of the fund is large cap companies. So these are companies that are bigger, they're more reliable, they're going to be around for a long time, but they don't grow as quickly as, say, medium or small cap. So this one does have a nice diversification throughout all of that. We did see the sectors beforehand. Now, the other thing I just wanted to check out was the price distributions, because I think, again, quarterly is nice. The more you can get that dividend passive income, ultimately the better. And we can see here they do have that consistent history of paying out dividends. And I do apologize, I did not look through that here, but I'm sure that we could find that if we did look. But, although the user experience on BlackRock is a lot better, and Vanguard looks like it was made in 1986, you do get a lot of the information that you're looking for from Vanguard. But you can see here there's a consistent history of paying the dividends every 3 months. So that's basically the gist of all three, or of these 2 ETFs, covering those 3 bases of looking at the MER. So what's the fee? What are they keeping out of the gains and returns out of the entire portfolio, really? And what do you get afterwards? And then the consistent or the good average annual returns over time, and then the consistent distribution history. Now, so I just wanted to highlight this. XAW is closed at $28.22, and VXC closed at $41.05. Now, the thing is, of course, though, is with $100, you can buy 3 shares of XAW, and with that same $100, you can only buy 2 shares of VXC. So that is something you also need to consider as well. Although XAW is paying dividends twice a year, VXC is paying it 4 times a year. However, the share price for XAW is about 2/3 of the share price of VXC, right? So you've got to consider, you also have to put that into the consideration. But basically, if you had $1,000 that you wanted to invest, 1,000 divided by the current share price, oh, no, my bad, 1,000 divided by the current share price would give you 35 shares. So with $1,000, you can buy a position, you can buy 35 shares of XAW. And then if we were to look at the difference, though, $1,000 to buy shares at $41.05, with the same $1,000, you'd only be able to get 24 shares. Now, again, these are not bad numbers or anything like that, but this is just to consider that the price does make a difference on the ability to actually buy in the first place. And then let's actually consider, hold on, let me write these down, 24.3 for for VXC, and then 35.43. But so let's just say if you bought 35 shares and the last dividend distribution, so if you bought 35 shares and the last dividend was 0.23 for XAW, those 32 shares would get you $7.36 of passive income. So again, it's not much at the start, but it is something. And the whole idea is that you start investing now just so that you build up your wealth over time, because we're all going to live a long, great life and a long, healthy life if you choose to. And this is just, it's a process of building wealth. And so just by doing this, by getting started, again, this is money you're making in your sleep. You're not doing anything for it. So you should always consider using your income from your job, if you can, to set aside a little bit of money to get these passive income streams in motion. And if we just compare this to 24 shares of VXC and their dividend, which is 0.18, so you will get $4.32. But again, this one's going to come 4 times a year. The other one's going to come twice. So, so let's just do this. Times 4, you're getting $17.28 in passive income for the whole year. And if we jump back to 35 times 0.23 for XAW, no, I didn't do that right. That's a different number than before then. 0.35 times, what was it? My bad, folks. Okay, so I must have done the wrong number beforehand. I do apologize for that. But you're getting 16 cents and on this one. And anyways, thank you, folks. That is the video. I do apologize. I do these videos on the fly. And I will structure them a bit more when I get more practice and get better at them. But I hope you can appreciate any of the value you got out of this. And if you did enjoy, please hit that like button again. And if you enjoyed this video and you want to learn more and you don't want to miss any of my new ETF videos, please make sure you subscribe. I do appreciate it, and it helps my channel a lot. And that way I can always send you the best stuff and keep you updated in ways that you can further diversify your portfolio. So thank you so much, everyone, for tuning into this video. Next one will be coming soon on these same global ETFs for US investors, and I'll catch you in the next one. Thank you so much.